With the collapse of Silicon Valley Bank and the following acquisition by First Citizens Bank, the startup ecosystem has been greatly damaged, losing a key banking partner for 50% of US venture-backed tech and life sciences companies. Silicon Valley Bank not only provided accounts for VCs and startups to deposit their cash, but also was the largest provider of a lesser-known but significant source of financing for the venture ecosystem: venture debt. Today we'll explain the venture debt asset class that has financed past startups like YouTube, AirBnB, and DoorDash as we survey the venture lending landscape and try to make sense of the future of venture financing with the loss of the top venture debt lender. As a segment of private credit growing alongside venture capital, which reached deal activity of $238.3 billion in 2022, the US venture debt market has grown more than 4 times over the past decade to $31.8 billion. Venture debt financing has accounted for approximately 10% of the total venture funding in the US over the last several years, and while still a small portion, is quickly gaining popularity as startups look for alternative sources of funding at a time when falling public market valuations, a frozen IPO market, and investor pullback from later stage and pre-IPO startups have created a widening funding gap. Venture debt, or venture lending, was originally coined in the 1970s to refer to equipment financing provided to early-stage companies that needed to acquire physical assets like hardware or lab equipment. Venture debt as we know it today began during the 1980s when the venture capital industry was growing rapidly, but many venture-backed companies were struggling to raise additional financing aside from equity. Traditional banks were hesitant to lend to these companies as they were often unprofitable or even pre-revenue. In response, lenders like Silicon Valley Bank emerged to provide venture debt without requiring physical assets or cash flow to venture-backed companies to extend the runway of a startup and grow to profitability or to a future equity round with less dilution to existing equity holders. When looking at types of financing in the capital stack, raising or selling equity is the most expensive cost of capital to existing shareholders, as losing ownership in a rapidly growing company could potentially be more expensive than paying fixed income payments at a specified yield. As a quick finance fundamental, cost of capital refers to the minimum return that would be necessary to justify an investment, which can be based on the return of similar assets. For example, if a 1-year treasury has an annual yield or return of 4%, a 1-year bond should have a yield or return equal to, but actually greater than 4% to justify an investment, as any less return would have an opportunity cost of the 1-year treasury that could have been invested in. When reviewing financing structures in the capital stack, there is an order for which investors receive priority in proceeds from a liquidity event or acquisition, and generally goes in the following order, with decreasing priority and therefore increased cost of capital: senior debt holders, junior debt holders, preferred equity holders, and lastly, common equity holders. Typically, venture capital invests in the form of preferred shares, but can also invest in safes and convertible notes, which are in the middle of the capital stack, having a mixture of characteristics between debt and equity. But as debt characteristics in the financing increase, the cost of capital should also decrease. Venture debt is typically senior in the debt stack unless it is equipment-specific financing, in which it would have a first priority interest in proceeds of equipment collateralized in the loan. To mitigate risk, venture debt loans are typically secured by the company's assets, such as intellectual property, accounts receivable, recurring revenue, or equipment, and are typically first to receive proceeds from a liquidity event or acquisition before convertible note or preferred share investors lower in the capital stack. Ultimately, venture debt is complementary to equity financing from venture capital and increases optionality by extending runway to allow the startup more time to meet product or commercial milestones and raise equity at an optimal market time and valuation. Further drilling down its complementary nature to equity, the best time to raise venture debt is actually after the close of an equity round. Generally, venture debt is underwritten based on the enterprise value that venture capital investors have priced a company at, and the startup's ability to raise another round of equity or get acquired. Venture debt differs from traditional underwriting as it relies more heavily on cash flows from equity financings rather than cash flows from operations for unprofitable companies. Venture debt can come in many forms and structures, including lines of credit, term debt, equipment financing, or royalty monetization. To dive into the mechanics of venture debt, the following are some common terms you'd find in a term sheet or venture debt agreement that may have overlap with other types of debt. Like all debt, Principal is loaned and is amortized over a given term at a specified interest rate until a maturity date where all principal should be paid back, resulting in the retirement of the debt. Interest rates can be fixed or variable, and venture debt terms are typically 3 to 5 years long, but like many of the following terms, can be amended to fit with the cash needs of the startup to get to its next funding or profitability milestone. Throughout the loan, there are principal and interest payments, but the timing of each principal and interest payment can be structured differently to tailor to a startup's cash flow needs. Venture debt may provide interest-only periods where principal paydown does not start immediately, so that debt payments are minimized at the onset of a company's operations as they grow. An extreme form of this can be found in bullet loans, where all principal amortization happens at maturity with interest-only payments before, effectively pushing out cash outflow and extending cash runway through reduced debt payments in the short term. Venture lenders also benefit from this by increasing their cash-on-cash return with more interest charged on a higher principal that is not paid down more aggressively at the start of the loan term. But the lender needs to be comfortable that the large principal can be repaid at the back end of the term. Interest payments are typically paid in the form of cash, but can also be in the form of PIK or paid-in-kind interest, which allows borrowers to pay interest in the form of additional debt or principal added to the loan balance in lieu of cash. By maturity, the original principal plus the PIK interest accrued needs to be paid back. PIK interest reduces startup cash outflows in the short term while increasing effective yields for lenders with a higher principal base to charge interest that compounds with each progressing PIK payment. Another supplement to yields and cash-on-cash return, venture lenders may charge a loan fee for time spent to underwrite the loan and start the relationship, along with other types of fees related to legal expenses and drafting agreements. Other fees common to venture debt include, but are not limited to, a final payment at maturity based on a percentage of the principal, maintenance fees, or default fees in the case that a borrower violates the loan agreement. In addition to debt payments from principal, interest, and fees, venture lenders also typically require warrants, a security that entitles a warrant holder to buy or sell stock of the issuing company for a specified dollar amount at a specified exercise price. Warrants effectively give lenders equity participation in a startup. The warrant coverage amount, or the dollar amount able to be used to purchase or sell a stock, is decided on a percentage of principal committed or advanced to a startup, while the exercise price is negotiated based on past prices paid for equity in previous rounds. Warrant coverage can be increased for higher risk companies with the bigger cash need, while warrant coverages can be minimized for cash-rich startups with no immediate capital need and extensive runways. In some cases, a venture lender may just ask for a warrant to buy shares to reach a specific fully diluted ownership of the company in cases where there is potential for the cap table to change with the conversion of convertible notes and safes. Very similar to options, warrants provide the venture lender with added equity upside for the venture risk taken in an unprofitable startup. In a successful outcome, warrants have the potential to change significantly in value as startup valuations change from round to round. The upside in warrants in the past have been marketed to investors as being able to pay off losses from other failed investments in the venture debt portfolio, but we'll discuss that further later. Private venture debt lenders may also add terms to invest equity in a following round to increase equity participation in special situations. When looking at just debt payments, venture lenders typically have a yield of 15% over the last decade, excluding warrant income. When adding in warrants, returns may increase by around 3 to 6% for a total return of 15 to 21%, presenting an appealing return profile for investors interested in fixed income. To mitigate exposure risk and observe performance of portfolio companies in a venture debt relationship, venture lenders can tranche or split up the advances or debt available to draw on their total commitments based on certain specified milestones. An availability period for commitments is usually stipulated to prevent draws at a time when cash runway may be too risky to advance capital, while tranches also incentivize the startup to perform to expectations over the venture debt term. To further secure debt, specific covenants can be added to fix guardrails around risky downside scenarios around a business. The most common ones are minimum cash covenants requiring the startup to never go below a specified cash balance, runway covenants requiring effective runway to not go below a certain amount, or profitability covenants where the startup is required to burn less or be more profitable at a specified rate. But covenants can also be made for unique situations based on discussions with management. An example is a recurring revenue covenant requiring a minimum amount of subscription revenue at any point in time for a SaaS company. Violating any of these covenants or other terms of the loan agreement would put the startup in default, where the venture lender can do a number of things to manage their risk, like amending the agreement to increase interest payments and fees, calling principal back, or foreclosure in the case of missed debt payments. As a lesser-known venture financing structure relative to equity from venture capital, there has been some criticism from venture capital investors with doubts on the viability of the venture debt model. But despite the high risk and failure rate of startups themselves, the loss ratios for venture debt portfolios are surprisingly low, and recovery rates are typically above 80% on defaulted loans. Looking at Silicon Valley Bank, annual average losses were less than 0.5% of principal from 2005 to Q1 of 2020. This includes the worst years of the Great Recession. While Silicon Valley Bank collapsed because of duration risk in its long-term MBS bonds, a topic I go over in a previous video, the actual venture debt portfolio performed quite well and is a good representation for the loss ratios driven by the risk management levers at a lender's disposal. But as a disclaimer, this video is not investment advice for any bank, lender, or the asset class itself. Before investing in any venture debt lender or bank, you must do your own due diligence on the track record of each lender and how well they have managed their portfolio to minimize losses on their principal. Nonetheless, there's no such thing as a free lunch, and there's always some trade-offs with any asset class. The biggest risk of venture debt is the introduction of the potential for over-leveraging and bankruptcy to creditors as a risk for young tech startups, as it must be paid back within a short time frame. While incentivizing the completion of milestones, venture debt may encourage acceleration of growth to challenging levels at the expense of long-term sustainability with its shorter-term periods and tranche milestones. Lastly, a key thing to note about venture debt lies with how venture debt is marketed. Venture debt presents a less dilutive option to founders compared to an equity raise, but warrants are usually part of a venture debt deal, so there is still some equity cost of capital baked in, albeit at a smaller amount. Venture debt has also previously been marketed to earn warrant income for a portfolio to theoretically pay off the losses on principals of other loans. But in a weak macroeconomic environment for a venture ecosystem, when defaults tend to rise, warrants are not countercyclical. In a recessionary environment, equity valuations also tend to drop as well, lowering volatile, unrealized warrant values at the same time as a default. In the long term, over many investments, warrant income may overcome losses in a portfolio, but on an individual company basis, this is usually not the case. Surveying the venture lending landscape, players can be bucketed into 4 groups: banks, direct lenders, fintech companies, and equipment leasers. Banks typically provide the lowest cost of capital with the lowest interest rates and warrant requests, but also usually have the most restrictions. As banks make money by taking cash deposited into accounts and lending it out for a higher rate or an interest rate spread, banks will tend to have many financial covenants to mitigate risk. Banks are the most risk-averse lending group and must back up their deposits with less risky assets, so venture debt may only be a smaller part of their loan portfolio. For bank terms, minimum cash covenants may be common, which will cash collateralize the loan, but also reduces the effective cash actually available to a startup, as cash is restricted from being spent or going down to a certain level. Ultimately, venture debt may just be one product for banks in their portfolio of financial services to have companies open up accounts to deposit cash. Direct lenders for venture debt are investment management companies that typically provide loans at a higher cost of capital compared to banks, but in exchange offer more flexible terms to operate within. Direct lenders must charge a higher cost of capital because of their business model, where they manage outside investor assets for a fixed fee and then are additionally compensated after return threshold is exceeded with carry. To exceed that return threshold, they must charge a higher interest rate or fees. Similar to private equity or venture capital funds, direct lenders may charge a 2% management fee on assets under management and 20% carry fees for any profits exceeding a certain return threshold. In exchange for a higher yield, direct lenders have less financial covenants and friendlier terms to operate flexibly throughout the relationship. Direct lenders can have publicly traded funds called business development companies or remain private. The main difference is BDCs have a permanent capital base to lend out of, with public investors, while private funds typically need to be raised with a fund life of 5 to 7 years before winding down and distributing back funds to outside investors, called limited partners. Fintech companies like Brex and Mercury operate similarly to banks with a portfolio of financial products to offer companies, but with added technological innovations. Venture debt has recently been introduced as another financial product to open new relationships and income sources with companies. For startups with hard assets or equipment, like companies within robotics, space technology, or electric vehicles, equipment-specific financing can also be funded by lessors. Instead of typical debt, an equipment lease would allow the lessor to finance equipment by buying it and renting a piece of equipment out to a lessee for a monthly rent for a fixed term instead of principal and interest payments. At the end of the term, the lessor will sell it back at a fair market value that is much less than the original purchase price of the equipment after depreciation. Leases are attractive as companies can have off-balance sheet financing and avoid showing debt on the balance sheet while expensing favorable lease rents. Additionally, leases do not require warrants, which is less dilutive. The main disadvantage to leases is the fair market value to repurchase the equipment item at the end, making the back end of a term and the overall cost of capital very costly, many times around or above 20%. Overall, startups may have different lenders co-invest together from different groups to optimize the capital structure. Starting in Q1 2023, major cracks in the banking system have now shown, driven by the rising interest rate environment with the collapse of many banks, including Silicon Valley Bank. As regional banks have suffered with bank runs, companies now need to manage deposit risk and have mostly chosen to spread their deposits among the big banks. These moves make big banks become even more too big to fail, further weakening the banking system. Silicon Valley Bank was initially established to provide banking to underserved startups, and was the ally to the venture ecosystem for decades. Now big banks like JP Morgan may not be able to maintain the same quality relationships with smaller businesses and startups with the sheer number of new clients flooding in. First Citizens Bank may have acquired Silicon Valley Bank and the largest venture debt portfolio, but it has big shoes to fill to regain its reputation to do business with startups and establish new venture debt commitments. Boardrooms and management may now be more wary of bank debt as it requires a bank account with the same bank that has new uncertainty as the dust settles. For banks, incoming regulations may further tighten the appetite for banks to provide venture debt, which will in turn reduce credit available following increases in interest rates. In a post-SVB environment, many will see opportunities to fill the void. Direct lenders are particularly well positioned to take market share as banks take a step back and try to stabilize their deposits. Some banks may see an opportunity to aggressively enter venture debt like HSBC and Stifel, hiring many former SVB bankers. As equity from venture capital dries up in a high interest rate environment, private credit may have the most to benefit, especially as startups rush to venture debt. Startups will need support in any way they can get, but the venture ecosystem's alternative financing option has now become more expensive.